To everybody. What a day yesterday. Welcome to all of you who are joining us for the first time. This is Toggle's daily video insight, and what we do in each one of these episodes is take a look at one of the insights amongst many produced by Toggle this morning on equities in and around the US. The goal is to really highlight a particular driver and the price pressure that might result from it to give you a sense of the power of the machine to really help you make these tactical investment decisions. If you'd like to see more of these, subscribe to our YouTube channel, or else you can also check us out on toggle.global, where you're able to see and test drive the Toggle Copilot, which is the system that we use in this. The focus today is going to be on Apple, and actually what we're seeing here is a really interesting latest insight that actually has been generated just on the back of analyst expectations. So in the asset overview, you see that actually Toggle has been highlighting quite a few positive pressures for Apple recently, but that currently the stock has been in a kind of a range. The latest insight, clicking on this, it will take you straight into it, is showing that a combination of analyst expectations and also momentum indicators suggest Apple could have 18% upside from here within the next 3 months. So basically bouncing back through the recent highs and onto about 147.21. Again, assuming that the price stays kind of within the confidence interval and does not dip below 113.53, which would be the stop loss level. Now, what is the driver here? Why is it that the system is highlighting that there's some upside pressure for the Apple stock? Clicking on the why it might move shows you that actually there are a number of things that are going on here, and in particular what we're seeing currently is that a combination of earnings growth as well as the momentum that seems to have been stretched quite a bit to the downside. You can see here that actually the 6-month momentum appears to be quite a bit down relative to where it was earlier this year and also late last year. Similarly, for the 3-month momentum, you're also quite a bit far from the highs, and you've just dipped below zero. So historically, although it's hard to see on this chart because the stock has been absolutely going only in one direction, these have typically been periods where a bounce back ensued. Now we can see this also by looking at the back test, and so what you're able to see here is that in situations where you've had this kind of a snapback driven by momentum as well as also good earnings, the subsequent returns have generally all been on the positive side. So the returns have typically far exceeded the target return that would have been suggested by the past insights. And here a quick proxy of what a dollar invested in each one of these past insights would have actually returned, and you see that you actually generate quite a decent return over the number of episodes that this has happened. Now, in order to get to this conclusion, Toggle has analyzed 6 similar occasions, so there have been a good number of them, but again, not enough to say that this is robust through a period of recessions and switches in business cycles, which is why it has 6 rather than 8 stars. So much for Apple today. In the daily brief, we also discuss ways to hedge the downside risk in your portfolio and some peculiarities around the volatility curve that might help with that. So check us out on toggle.global, and if you're subscribed to Daily Brief, it should already be in your mailbox. Thanks again.